You're scrolling through the news, and every headline feels like the world's coming apart at the seams. America threatening military action against Denmark over Greenland. Russia grinding through year 4 of occupying Ukraine. China running military drills around Taiwan like it's a dress rehearsal. And across Europe, political movements that seemed impossible 5 years ago are now forming governments. You look at your investment account, your pension, your savings, and for the first time, you're asking a question that feels almost ridiculous to say out loud: what happens to my money if everything actually falls apart? That's not paranoia, that's pattern recognition. Because if you look at history, not the sanitized version they taught you in school, but the real version, the one with all the uncomfortable parts left in, you'll see something terrifying. Peace is the exception. Chaos is the rule. And the investors who survive are the ones who prepare for both. My name is Leo. I learned investing in the United States, then moved to Europe and spent 9 years figuring out what actually works here, which means I've had to think about risks that American investors never consider. Geographic risks. Currency risks. The kind of risks that come from living on a continent that's seen empires collapse, borders redrawn, and entire economic systems wiped out within living memory. If you're trying to build real wealth in Europe while protecting it from an increasingly unstable world, make sure to hit that subscribe button and give this video a thumbs up, because we're about to cover strategies most financial advisors won't even acknowledge exist. Here's what I'm going to show you today. 6 specific strategies that can protect your investments from geopolitical disasters, from revolutions to hyperinflation to government confiscation. And I'm going to be honest with you, most of these precautions probably won't be necessary in your lifetime. But the ones who lost everything in 1917 Russia, 1949 China, 2001 Argentina, and 2012 Greece all thought the same thing right up until the moment it happened. Now, before we get into solutions, you need to understand something about the last few decades. We've been living through an anomaly. Yes, we had COVID. Yes, we had the 2008 financial crisis. Yes, we had 9/11. But zoom out. Since the end of the Cold War, Europe has experienced a level of peace and stability that's almost unprecedented in human history. No major wars on European soil until Ukraine. No hyperinflation. No violent revolutions. Borders that stayed mostly stable. For anyone under 50, this has been your entire experience of reality. And it creates a dangerous assumption that this is normal, that this is how things always are and always will be. But that's exactly backwards. This 30-year period of relative calm isn't the historical norm, it's the exception. And exceptions don't last forever. Let me show you what the actual norm looks like throughout history, because this is where most modern investors have a massive blind spot. They think black swan events are these rare, unpredictable anomalies. They're not. They're predictable. They happen regularly, and they absolutely devastate investors who aren't prepared. Now here's what makes this relevant to you. Every single one of those investor classes thought it couldn't happen to them. They had wealth, they had connections, they had property. They assumed stability would continue because it always had in their lifetime. They were catastrophically mistaken. But revolutions aren't the only pattern. Let's talk about war and confiscation, because this one's particularly interesting and almost nobody knows about it. During World War I, stock exchanges across the world shut down for months, not because of physical damage, because governments couldn't allow capital to flee, and the United States created something called the Office of Alien Property Custodian. Its job was to confiscate investments from citizens of Germany, Austria-Hungary, and the Ottoman Empire. Any stocks, bonds, property, businesses owned by people from enemy countries seized. The office became the world's largest trust organization practically overnight. World War II, same thing, but bigger. And here's the uncomfortable modern parallel. In 2022, when Russia invaded Ukraine, Western countries froze Russian investments. Billions of euros worth of assets, just frozen. Russian citizens who had money in European banks, European stocks, they can't access it. Will they ever get it back? Nobody knows. The precedent is now set. In a major geopolitical conflict, your investments can be frozen based on your passport, regardless of whether you personally did anything questionable. Then there's sovereign defaults, and this one should terrify European investors specifically because it's happened recently and it can absolutely happen again. Russia, 1998. The government defaulted on its bonds, triggered a global financial crisis. Investors who thought Russian government debt was safe, they lost fortunes. Argentina, 2001. defaulted on over $100 billion. Investors took massive losses. But here's the one that should make every European pay attention. Greece. 2012. The Greek government defaulted on 26 billion euros in debt, and investors, including European pension funds and individuals who thought Eurozone government bonds were absolutely safe, lost approximately 70% of their money. 70%. Let me say that again for the people who think government bonds are risk-free. Greek bondholders lost 70%. In the Eurozone, in this century. That actually happened. And then there's hyperinflation, which is what governments do when they're deep in debt and don't want to formally default. Germany in the early 1920s. The Papiermarkt collapsed so completely that prices doubled every few days. People would get paid and immediately run to spend it because by the next day it would buy half as much. Savings were wiped out. Bonds became toilet paper, literally, because paper money was worth less than actual toilet paper. Hungary after World War II had the worst inflation in recorded history. The Pengai. Prices doubled every 15 hours. 15 hours. If you went to work in the morning and got paid at the end of your shift, your wages had already lost half their value. More recently, Bolivia and Argentina in the 1980s. Zimbabwe in the 2000s. Venezuela in the 2010s. Same pattern. Government prints money to solve debt problems. Currency becomes worthless. Anyone holding cash or bonds loses everything. Now I can already hear what some of you are thinking. That's developing countries. That's unstable regions. That's not Europe. Really? Because Greece happened. Cyprus happened. Let me tell you about Cyprus 2013 because this one gets memory hold and it absolutely shouldn't. The Cypriot banking system was collapsing. And the government decided that to bail out the banks, they would freeze everyone's accounts and take up to 50% of deposits above 100,000 euros. Not from failed banks, from surviving banks. You had money in a Cypriot bank that stayed open, and the government still took half of it. In Europe, in the Eurozone, in the 21st century. If you don't think that can happen again somewhere else, you're not paying attention. What I'm about to show you next is the thing that took me years to figure out, and it goes against everything most financial advisors will tell you. Because most advisors are optimized for stability, they're selling you products designed for a world where nothing fundamentally changes. But we need to prepare for both worlds. The world where everything stays mostly stable, and the world where it doesn't. Strategy 1. Accept reality. This is the foundational mindset shift, and without it, none of the other strategies matter. You have to stop living in denial. Stop assuming that business as usual will continue forever just because it's continued for your entire adult life. Now let me be very clear about what I'm not saying. I'm not saying you should panic. I'm not saying you should assume disaster is inevitable next year. What I'm saying is this. The probability of any single specific disaster in any single year is low. A communist revolution in Germany next year? Unlikely. Hyperinflation in France by 2027? Probably not. But here's the math that matters. The probability of experiencing some major geopolitical or economic disruption somewhere in Europe within the next 5 to 10 years, with the current trajectory, that's not low anymore. That's significant. And if you're investing for 20, 30, 40 years, the cumulative probability of experiencing at least one major crisis that affects your wealth approaches certainty. So prepare mentally and financially. Don't stick your head in the sand assuming it can't happen to you because you live in a nice neighborhood in a stable country. That's what everyone thinks right up until it happens. Strategy 2. Maintain liquidity. And this is where a lot of wealthy Europeans make a fatal mistake. They tie up all their wealth in illiquid local assets, a big house, an apartment building, a local business, and then when crisis hits, they're trapped. Let me give you the historical example that illustrates this perfectly. French nobles during the French Revolution. Their wealth was in land, estates, chateaux, completely illiquid. When the revolution came, they had a choice. Stay with their property and lose their heads, quite literally, or flee to England or Austria with nothing and start over from zero. Same pattern in Cuba. Wealthy landowners and business owners who fled to America, they became gas station attendants and taxi drivers because all their wealth was in Cuban property they couldn't take with them. The lesson is simple. Keep at least a meaningful portion of your wealth in liquid financial assets that can move quickly if you need them to. Now, the extreme position is also risky. Being 100% liquid in financial assets means if the global financial system freezes or the online economy collapses, you're vulnerable. And owning some real assets, an apartment, a local business, provides a hedge against that. The key is balance. Don't identify your entire personal worth with immovable property, because the families who held on to the ancestral farm, the family shop, the historic estate, they often lost everything when circumstances demanded decisive action and they couldn't bring themselves to let go. Strategy 3. Geographic diversification of accounts. Never trust all your money to a single local bank or even a single foreign institution. This used to be incredibly difficult. Opening a foreign bank account required flying to another country, sitting in meetings, providing massive documentation. But now, with online banks and brokerages, this is actually accessible. You can open an account with Saxo for Danish-based brokerage accounts, N26 or Trade Republic for German-based bank accounts with German deposit guarantee protection. And yes, I know some of you have American bank accounts from when you lived there or worked there, and you might think that's great diversification. But here's the thing. Given the current US-Europe relationship and where that might be heading, concentrating too much wealth in America creates its own geopolitical risk. I'd recommend spreading across multiple European countries. Spain, Germany, Denmark, Ireland, different jurisdictions, different legal systems, different deposit guarantee schemes. That way, if one country freezes accounts or imposes capital controls or has a banking crisis, you're not completely locked out of your wealth. Yes, it's more complicated. Yes, it requires more management. But that complexity is insurance. Strategy 4. Appropriate cash allocation. Never keep all your wealth sitting in bank accounts. Cash at the bank is vulnerable to two things: bank collapses and hyperinflation. You should maintain a safety cushion covering several months of living expenses in one or a few major currencies: euros, dollars, Swiss francs. But here's the critical rule. Never exceed 100,000 euros in a single bank. That's the deposit protection guarantee limit in the EU. Above that, if the bank fails, you're an unsecured creditor and you'll probably lose most of it, as Cyprus demonstrated. And prefer banks in strong, stable countries. The German deposit guarantee is more reliable than the Cypriot or Latvian one, to put it mildly. Everything beyond your safety cushion should be invested, not sitting as cash, because cash loses value to inflation every single year, and in a crisis, it loses value catastrophically. Strategy 5. Avoid overconcentration in bonds. I know this goes against what a lot of European financial advisors tell you. Many Europeans view bonds, especially government bonds, as the safest investment. It's a misconception, and it's a dangerous one. Bonds have three massive problems. 1. Governments sometimes default, as Greece definitively proved. 2. Bonds can fall dramatically in value when interest rates rise, which is exactly what happened in 2022 when everyone who owned long-term bonds watched their value crater. And 3. Inflation destroys bonds because bonds pay a fixed schedule of currency over time. If inflation takes off, if we enter a hyperinflation scenario, your bonds become worthless. You're getting paid back in money that can't buy anything. Now, do bonds have a role in a smart long-term portfolio? Yes, especially as you age and want to reduce volatility. But never put all your wealth in bonds thinking that guarantees safety during geopolitical crises. It doesn't. History proves it doesn't. If you've made it this far, you're already ahead of 90% of European investors who refuse to even think about these scenarios. But don't stop now, because what comes next is where you actually build the resilience that lets you sleep at night regardless of what headlines you wake up to. Strategy 6. Stock market diversification via exchange-traded funds. This is your foundation. Here's why stocks are actually more resilient than most people realize. Stocks represent ownership in real companies where people work every day to serve clients and earn money. And historically, stocks have outperformed inflation substantially in most countries. Even during periods of extremely high inflation, because when prices rise, company revenues rise too. Now yes, communist revolutions make stocks worthless. If the government seizes private property, your shares are gone. But overall, across most historical scenarios, stocks have proven remarkably robust. The challenge is choosing among thousands of individual stocks. Which companies, which countries, which industries? You could spend your entire life researching and still get it wrong. That's where ETFs and index funds come in. They invest in hundreds or thousands of different stocks across countries and industries globally. Harry Markowitz won a Nobel Prize for proving that diversification is the only free lunch in investing, and that diversification protects you not just financially but geopolitically. If there's a communist revolution in one country, you only lose the fraction of your portfolio allocated to that country, not everything. The classic passive approach is market cap investing. Your money goes automatically worldwide in proportion to stock market sizes. Simple global ETFs like the Vanguard FTSE, All World UCITS ETF, or the iShares MSCI ACITS ETF invest in thousands of companies across dozens of countries. One fund, global diversification, done. But here's the obvious problem. All world ETFs currently allocate approximately 60% to America because America has the world's largest stock market. Now, American stocks have performed incredibly well over the last century. The American market has enormous internal diversity across industries and companies, but every single American stock, no matter how good the company, faces exposure to decisions from one very stable genius in the White House. And that concentration risk is real. So here's how you think about total exposure. Consider the location of all your financial assets, not just your stocks and ETFs. I've talked to plenty of people who worry about US exposure in their ETFs, and then we look at their full financial picture and discover the ETF represents maybe 10 or 20% of their net worth. The other 80 or 90% is in Spanish real estate or an Italian private business. For them, an all-world ETF is perfectly fine because only a small fraction of total wealth has any American exposure anyway. But if you're someone whose ETFs represent all of your invested wealth, then yeah, 60% US exposure might feel excessive given current geopolitical uncertainties. One solution is a home bias strategy. Invest 20 to 40% of your stock portfolio closer to home where your investor rights are better protected. If you're in a major market like the UK, Germany, or France, this could mean 20 to 40% in your domestic stock market. Or you could use European diversification via an ETF like the iShares Core MSCI Europe UCITS ETF. You get exposure to hundreds of European companies across multiple countries without putting all your eggs in one national basket. There are many valid approaches for building a diversified global portfolio. The key is thinking through the geopolitical implications, not just the financial returns. And here's a technical point specifically for European investors. Prefer ETFs that are domiciled, meaning legally established in European countries. Now, if you're an EU or UK resident, you're actually restricted by regulation and can only buy local ETFs anyway, which are typically Ireland or Luxembourg based. But if you're in other European countries like Switzerland, Georgia, or Ukraine, you can access American domiciled ETFs too. My recommendation: use European domiciled ETFs for your non-US holdings to reduce the risk of American political interference with your investments. For American stocks specifically, the domicile matters less because you've got US exposure either way, but for everything else, keep it in European legal structures. Now we're in the home stretch, and I need to show you how all of this works together, because the real magic isn't in any single strategy. It's in how they combine to create a system that's resilient across multiple scenarios. Think about what we've built here. You've accepted that the future is uncertain and prepared mentally for multiple possibilities. You maintain liquidity so you're never trapped by immovable assets. You've spread your accounts across multiple countries and institutions so no single government or bank failure wipes you out. You keep appropriate cash reserves, but not so much that inflation destroys you. You avoid overconcentration in bonds so you're not vulnerable to defaults or currency collapse. And you own globally diversified stocks so your wealth participates in human productivity and innovation across the entire world, insulated from any single country's political decisions. That's not paranoia. That's prudent risk management. That's what wealthy families who survived multiple crises over generations have always done. Here's the thing most people don't understand about preparation. Taking these precautions doesn't mean you think disaster is certain. It means you're ready for multiple futures. If the next 20 years are peaceful and stable, fantastic. Your globally diversified portfolio will grow. Your geographic diversification costs you almost nothing. Your liquidity gives you flexibility to seize opportunities, you win. And if we do hit major geopolitical disruption, war, financial crisis, inflation, sovereign default, whatever form it takes, you don't lose everything. You take a hit, sure, but you survive. You have options. You can relocate if necessary. You can access your wealth. You can rebuild. The families who lost everything in past crises didn't lose because they were stupid or unlucky. They lost because they assumed stability would last forever and they had no backup plan. Don't be them. And let me be very clear about something. I strongly believe that all Europeans should save, invest, and build financial freedom regardless of what the future holds. Because whether we get peace or chaos, prosperity or crisis, having investments makes every challenge easier to handle. The question isn't whether to invest, it's how to invest in a way that's resilient to multiple futures. Now, I know that European investing can feel overwhelming. You've got questions. Which broker or app can I actually trust? What strategy suits my specific age, goals, and tax situation? When should I start? Should I invest a lump sum or spread it over time? How do I handle the taxes? These are real questions, and they matter. The systematic education through video content like this helps address these questions progressively. You watch, you learn, you implement piece by piece. But some people prefer a more structured approach, an intensive training program that takes you from A to Z with personalized support and a clear roadmap. Both paths work. The question is, which one fits how you learn best and how quickly you want to get up to speed? Here's the core message I need you to walk away with. Geopolitical risks are real and historically recurring. They're not anomalies, they're the pattern. European investors face a unique combination of opportunities and vulnerabilities. Access to incredible markets, strong legal protections in many countries, but also proximity to geopolitical tensions and a complex regulatory environment that changes constantly. Proper preparation doesn't mean pessimism. It means building a resilient portfolio that can withstand various potential disruptions while still participating in long-term wealth creation through quality investments. The goal is confidence regardless of which future scenario unfolds. You want to be able to read those headlines about military tensions, political upheaval, economic uncertainty, and know that you're prepared. Not panicked, not paralyzed, prepared. So let me ask you this. What geopolitical risk keeps you up at night? Is it inflation, government overreach, banking system instability, war, political extremism, tax changes? Whatever it is, tell me in the comments. Because that's what this channel is for. Breaking down the complex financial realities that affect your life and finding strategies that actually work in the real world, not the fantasy world where everything stays stable forever. You're not pushing a boulder uphill hoping the slope levels out. You're building a system where the boulder rolls on its own, where your wealth grows and compounds regardless of which direction the political winds blow. That's the difference between hoping for the best and preparing for everything. Your future self, the one who navigated whatever the next decade brings and came out financially secure, is counting on the decisions you make right now. Make them wisely.